amortization. So what is loan amortization? In easy word, loan amortization is all about how you would repay the loan, or you can say principal over time. Okay. For example, if you remember that there are two basically parties. The one is borrower, known as, or the person who basically received the loan, receiver. Okay. Other one is lender, or you can say the person who gave the loan. So lender are those we normally consider them as a bank, and borrower are the customers. For example, if you wanted to buy or to borrow the loan from the bank, let's say for a 5 lakh for the next 5 years, and you ask the bank that I'll pay you 1 lakh in each month, 1 lakh in each year. So at the end of, for example, you buy a loan for a 5 lakh for how many years? For 5 lakh. Okay. For how many years? 1, 2, 3, 4, and 5. And you said that I would pay you 1 lakh in each year. Okay. So in the end, I'll pay you 5 lakh complete. In that situation, bank will not appreciate your commitments, your agreement, because what bank will get in return after 5 years? If they are getting their amount as they gave it to you, then nothing, or you can say this cannot happen in this realistic world, because obviously bank will demand for its commission, bank will demand for its profit. Okay. It's something you can say realistically they would ask for. Okay. So what would be the condition? First, I am just summarizing it for all of you, just need to memorize. An amortized loan is a loan with scheduled periods, payments that consist of both principal plus interest. Okay. What is the condition? For example, if you wanted to buy, let's take a same example. Bank said if you wanted to buy or to borrow 5 lakh, then you would pay 10% on it in every year. So at the end of 1 year, you said I will pay 1 lakh in each year. So 5 lakh 10% is 50,000. Okay. So initially 1 lakh, according to your commitment, you would pay principal amount plus 10%, which is known as 50,000, you would pay their interest. So in year 1, how much you would pay? 1,50,000. Okay. When you will deduct this amount from a total amount, which is 5 lakh, how much we have in year 2? It's 4 lakh. Okay. Again, you would pay 10% on it. So 1 lakh you are going to pay as per commitment, plus 10% of 40 lakh, 4 lakh becomes 40,000. So in year 2 you would pay 1,40,000. 1 lakh your principal amount, 40,000 your interest. Third year, how much we have? 3 lakh. 3 lakh multiplied by 10%, again you would have to pay. So 1 lakh as per commitment plus 10%, which become 30,000. So in year number 3 you would pay 1,30,000. Year 4, how much you would pay? How much we have? Basically 2 lakh. multiply by 10%. So initially you would pay 1 lakh as per commitment plus 20,000 of interest. So you would pay 1,20,000. And if you go on to last year, so remaining amount you would pay 1 lakh multiplied by 10%. So you would pay 1 lakh plus 10,000. Okay, so that's become 110,000. So 110, 20, 30, and this become 1,50,000 you would pay as an interest rate by again giving them the principal amount of 5 lakhs. So what I am saying in the definition, an amortized loan is a loan with the schedule periods payment that consists of both. What's both? Principal plus interest. An amortized loan payment relevant interest expense for the period before any principal is paid and reduced. Let's talk about an example, then we will move ahead. How we can solve this? Example is that you just have to borrow, for example, $10,000 from a bank for a 5 years. So how much you are going to borrow? $10,000 for 5 years. The loans call for a fixed annual payment at the end of each year. So how much you would pay? So you would pay at the end of each year. So you are going to borrow $10,000 for 5 years, and you have to pay at the end of each year. And the annual interest rate loan is 8%. And uh, what what must your annual payment be? Okay, so present value, how much we are getting is $10,000 with an interest rate of 8%. So how much we have to receive at the end of each year? So how much we have to pay? So we have to calculate R, series of equal payments. So what is the formula is present value, and R is equal to 1 minus 1 over 1 plus I power n divided by I, because it's at the end of the years. Then because of that we are doing annuity due case. And let's see what will be the amount is $10,000 is equal to C 1 minus 1 over 1 plus 0.08 power 5 and divided by 0.08. So amount what we are getting is 2504.56. This is the amount we would receive at the, this is the amount we have to pay, or you can say year end pay. Okay, let's make a table just to summarize it. Year, beginning balance, then we have interest, then we have year end payment, then we have principal paid, then end year balance. Okay, let's see what will happen for 5 years. For 5 years. Okay, initially year number 1, how much it starts from? 10,000. Interest rate, how much interest we basically calculate that is, if we calculate the interest rate, so 10,000 multiplied by with 8%, so how much we can get is 800. Okay, so year end payment, how much payment we would have to pay is 2504 04.56. Okay, now principal paid, how much principal amount you would pay. Remember that principal paid here, principal paid is equal to year end payment minus interest. Okay, year end payment was 2504.6 minus, when you will deduct interest from year end payment, so that would be your interest paid, that's become 1704.56. Okay, and year end balance, and year balance would be, and year balance would be beginning balance minus principal paid, and how much you have is 8295.44. So that is the condition in case number 1. Now what happened, let's see in year 2. Year 2, so what you have to do, the the ending balance of the last year would be the beginning balance of the next year. So how much we have the beginning balance, and the ending balance of the last year was that 8295.44. Okay, then what you have to do, you would calculate interest rate on that amount. Okay, 8%, so how much you have is 663.63. so year end payment would remain same, which is 2504.56. Okay, now what would be the principal amount? The idea would remain same, the principal paid year end payment minus interest rate, and if you do that you would get 1840.93, and year end balance would be for the end of year number 2 6454.53. Let's move on to case number 3. Year number 3 is the closing balance of the year number 2, which is 6454.55. Okay, if we calculate the I, which is interest, it would be 516.36, and it would remain same 0.56. When you calculate the principal paid amount, it would be like 1988.20 and 4466.32. Move on to year number 4. And then we will calculate year number 5, which is the end year. Okay, year number 4, 446632, and what would be the interest rate is 357.31, and it would remain same 4.56, and idea would 2147. When we calculate the principal paid 0.25, and that would be 2319.06, and we move on to last year. So the starting balance would be 2319.06. If we calculate the interest on it, it 185.52, and it becomes 2504.56. When we calculate the principal paid, that would become 2319.04, and how much you would get 0.03. it should be 0, but because of some decimal amounts and the amount we are taking after the points, because of the results we are getting 0.03, but it should be 0. So if you wanted to calculate, so what you have to do, you have to add your beginning balance plus your interest rate. Answer would be similar to this one. Okay, so that was a simple calculation of our loan amortization. Hope you get a clear idea that what does it mean. Now, the last topic of this chapter is sinking cost, sinking fund. Sinking fund. This is the last topic or the last topic of our conversation. What is sinking fund? An annuity sinking fund in any series of equal regular payments to build up the balance. Or you can say this is a spare fund you use for spare fund. It's not actually spare, but you make it spare. Okay? It's a spare fund used for pay off debts. You may use it to pay off debts, to purchase new assets. It could be replacement or the replace your old equipments. So what you do, you basically draw some amounts from your profit or from your saving to that account to use for all these activities. So what you said, a fixed amount is drawn from available profit and then invested in the some business, and this investment is released at the time of redemption of the debentures. So this is basically a sinking fund. So you just have to make another account, you just have to make another funds to just put an impact or to respond all these activities whatever I mentioned on the screen. So let's take an example to solve the sinking funds. For example, find the amount of each payment to made into a sinking fund to accumulate the given amount. Payments are made at the end of each year. So what is the condition? Condition is that we have to find a payment, okay, and payment are made at the end of each year, and the condition is that we have basically 65,000 amount, okay, earns at interest rate 6% for 4.5 years. Okay, so future value of S of an annuity ordinary used to accumulate S sink and R into 1 minus I plus n power n minus 1 divided by I. So what is the situation? We have basically 65,000 which we are going to sink that amount, 65,000, R which we have to calculate because we have to make a prices, we have to make an cash flows. Okay, so what they said, we have a money of 65,000, okay, and total amount which we earn 6% of interest rate for 4.5 years. So we just wanted to keep some sig fund in every year, so how much we can save it. Okay, so sink initially we have 65,000, so we wanted to save an amount, so how much we can get. 1 minus sink is 0. Uh, okay, let's say it's based on semi-annually. Okay, based on semi-annually, so that 6.6 become 0.03 power we have for 4.5 years, so we will multiply by 2, that's become 9 minus 1, and then that's become 0.03. So we have basically R, which is equal to 6398.20. so what you can say that this is what your payment would have to be semi annually for 4 years to accumulate the $65,000. So that was basically the last idea, a very simple concept of the sinking fund. Hope you have a better understanding.